OC Financial Media presents, in association with CHL Mortgage, as heard on KTLK AM 1150, from LA to Orange County.
Your host, Dino Katsiametis.
It's about your real estate. It's about your money. From your estate to real estate, it's Money Matters with Dino.
Welcome back to Money Matters with Dino on K-Talk AM 1150. If you have any questions for myself or my guests, or if you need help with your money matters, give us a call at 949-720-1616. That's 949-720-1616, or check us out online at moneymatterswithdino.com. From your estate to real estate, we're here to help. This segment is brought to you by Title 365. Faced with the simplest or the most complex real estate transactions, customers trust the professionals at Title 365 for reliable, accurate, and secure title insurance and closing services. Call me direct at 949-720-1616. Joining us today in our discussion panel with the experts are returning. All of these guys are actually all returning this time. Bill Baskin from CDA Law Center, financial planner Bart Zandbergen, and credit repair specialist Corey Goldstein. Today our topic is Rebuild Your Fortune, starting now. Welcome to the show, guys.
Thank you.
Thanks, Dino.
Good to be here.
So all of you guys have been here before, and you were invited to come back because we really feel like this topic is an important one in today's economy. You know, a lot of people took some big hits, either by losing their house, losing their jobs. Unfortunately, a lot of people lost their retirement, and some of them much older and further along in life that, you know, they're just not going to get a chance to rebuild. But with you guys, we want to talk a little bit about what's happened, talk about some of the tough decisions people made, and then of course, you know, the road to recovering, how to get back to where they need to be in order to retire again. Bill, let's start with you. Tell me a little bit about CDA Law Center and what you do there.
Well, CDA Law Center has been doing loan modifications since 2008. We've successfully completed about 5,000 loan modifications. Very selective on the clients we take. We apply their financials and apply the guidelines to those financials and determine who is a candidate, who is not, because there's certain things we have to prove to the bank, and not everybody can prove those things. So, you know, if you're a viable candidate, it's a great way to save a lot of money on your mortgage payment. Which
I've said this a lot about CDA Law Center, and first and foremost, they're still in business. The majority of the loan mod companies out there are out of business, and the reason why is because most of them were crooks or just didn't do things the right way. And you know, being in the mortgage business, I've dealt with a lot of them, and that's why, you know, here on my show is Bill from CDA Law Center, because what Bill said is actually very important. They actually don't take clients unless they really think they can get the job done. And that's, to me, a very upfront and you know, just the right way to do business. So thanks for being on the show, Bill.
Great to be here.
And Bart.
Yes, sir.
Tell me about what you do.
Well, my firm is Financial Management Network. We're a full-service financial planning and asset management firm. We're a boutique firm. We manage just under $1 billion in total, and I think what really sets us aside is generally prior to taking the client's money is we'll go through a full comprehensive financial planning process, and that will really help to determine what kind of risk the client really is willing to take and really what their end goals are. Because it's really that goal in mind that really drives what the asset management direction should look like.
Well, we're looking forward to your comments here and expertise on answering these questions today. And Mr. Corey Goldstein, this man I haven't known for a very long time, but since the day I did meet him, I have been fortunate enough to be able to see him put his talents and skills to use here. By fixing several credit reports and doing it, what I'd say is in a timely manner. And I'm talking like less than a week. Yeah. The guy here, the dude here gets freaking credit scores up by 40, 50, 60 plus points in less than a week.
Well, you know, we're here for a short time, so we want to maximize our life, you know? Want to get back in the game of life instead of sitting on the sidelines.
So what do you do? I mean, how do you do it? What makes you so different from everybody else?
Well, Fix My Report is the website, fixmyreport.com. And, you know, the primary thing, the distinction that's out in the market is, you know, credit repair, right? You know, the 30,000 foot view of credit repair kind of lumps everybody in together. So I kind of get lumped into that. What I don't do, I'll share with you what I don't do, is I don't send out letters looking for information to fall off the report in 30, 60, 90 days or 6 months or a year. And because it's not reliable. You can't count on it. It's going to pop back on again. Nothing's permanent, nothing's guaranteed. So as a loan professional, when you're trying, to get a deal done, or a person trying to resolve their financial situation, you want to have some certainty. So what I do that's different is directly negotiate with your client's creditors and look to permanently remove information off the file, regardless of its accuracy.
Did you just say regardless of its accuracy?
Yeah. I was waiting for a little, regardless of accuracy. So instead of looking at, the black and white, was he late, was he not late? Bill and I were talking, so I look at the circumstances. Like you, look at the circumstances surrounding the situation. Our whole country is based upon a FICO score, but nobody in the world can explain what the heck it is, right? So it's really
literally even the credit bureaus don't. The people that work there have no idea how that score is made up.
And Dino, it's so interesting. I read this information. There's actually 96 ways to report a derogatory piece of credit and 6 positive ways to report a piece of credit.
Sounds like my wife describing me.
Well, you can see. So I'm looking at the circumstances surrounding it. If we're already set up to lose, right? We're already set up to lose.
Yeah.
How can we leverage the playing field?
Well, we're looking forward to your expertise here, and like I said, we're talking about rebuild your fortune starting right now, and that again is basically we all had to make some very difficult decisions. Some of us had to let go of our houses, and others lost their job. Just a bunch of unfortunate things that happened during this Great Recession. So let's just start off with the first question. Sometimes people have to start over because the market crashes. You lose your job, etc. And it was completely unpredictable. But sometimes people have to start over because they made mistakes. Do you recommend an analysis of how the losses happened before moving forward with a plan to rebuild wealth? Bart, I'm going to guess that one's for you.
Yeah, without a doubt. And part of the basic process is, as a client comes in, regardless of what they've been through, is really take a look at where have you been and how did you get here? And that will help determine what sort of attitude or especially investing attitude this client has. And if they have a temperament towards high risk or gambling, that could have been a big cause for their losses, and we'd have to reevaluate that to see if that's something that's going to work for them in the future.
Well, let me ask you this. Yeah, even conservative people lost all their equity in the house. I mean, there's everybody got hit. So, one could say that the aggressive people did, but at the end of the day, didn't everybody get hit?
Yeah, there's absolutely some truth to that, a lot of truth to that. And in that case, still the person has to be evaluated, or the situation has to be evaluated. And whether it was within their fault or not, we still need to know how it happened. And we still need to make decisions on how to move forward.
Out of curiosity, was there an age group that was, in your opinion, affected more than others?
Good question. Probably the 30 to 50. Age 30 to 50.
Bill, what about in the loan mods? Do you see that at all? Can you pinpoint an age group?
30 to 50 would probably be the demographic we see the most of, although, all the way up to, I've had 95-year-old guys, hire us to fix their loan. They got put into a bad loan during the boom, and it's kind of universal. 60% of California is upside down. 700,000 people are seriously delinquent on their mortgage currently. There's been millions of foreclosures across the country. If you're a homeowner, it's impacted you. The question is, did you have a significant life event on top of a financial recession, that caused you to either fall behind or struggle with the mortgage?
All right, Bill. So here, this next question is for you. We had the financial meltdown, which affected everyone's portfolio. But as we know, it started with the housing market. There were tons of foreclosures and homes underwater. And one of the ways out was a loan mod, a great tool if it's available to you. Tell us, start us off with how a loan mod works and what it really does to help the homeowner.
Sure. A loan modification is basically a restructuring on a voluntary basis of the loan that you're currently in by the servicer, who's empowered by the investor who owns the loan, and they allow servicers to modify the terms of the loan in the instance of a delinquency. We see two types of clients. One who've faced a pretty severe financial hardship over the last 4 or 5 years, lost income, lost job, and so on, where they can no longer afford the mortgage. But probably half of our clients are doing it for strategic reasons. They got put into a bad loan. They're in a fixed rate adjustable loan. They're in an adjustable loan or a negative amortization loan. They're leveraging savings, they're leveraging investments, they're leveraging credit cards to stay current on their mortgage. They have a financial hardship, although they're managing to kind of keep their fingernails on the edge of the cliff, but they're wasting away savings and credit card debt to keep current on their mortgage, when the reality is they could apply for a loan mod, potentially save hundreds or thousands of dollars on that payment, and use that money for to actually be saving for the retirement. Invest with Bart or his firm, or buy an annuity or do something with that money rather than draining savings to stay current on 3% interest rate.
And what does it take to get a bank to agree to a loan mod?
The proper package. This is a government program. You either meet the guidelines or you don't. We create a financial package that meets all 800 pages of the HAMP guidelines. It proves hardship, it proves capacity to pay the modified payment, but most importantly, it proves net present value, that the investor will make more money by modifying than they will by foreclosing. And in those cases, with rare exceptions, a servicer will typically modify the loan, lower the payment, lower the interest rate, even reduce principal.
Do you see principal reduction happening a lot?
A lot is a relative thing. We do get a lot of principal reductions, but not in every case. It's not something you negotiate for. It's earmarked by the investor. Many investors realize, their greatest fear is if a loan redefaults after a modification.
Right.
There's a lot of accounting processes, moving loans in and outside of homogeneous pools, and they don't want a loan to redefault. And a lot of investors have come to the position where, hey, if we reduce the principal and give the borrower some stake in the game, they're a lot more likely to maintain that payment and be a performing loan for the life of the loan. So, we see them in about 30% of the cases, but they're substantial. I mean, I remember I saved a guy 2 months ago. He had a $1.4 million loan. We got him an $830,000 principal reduction.
Oh my gosh.
He didn't think it was enough, by the way. But,
Oh my God.
Can't fix crazy.
Yeah, right. Great work.
And what about the sudden increase in value that we've had? Has that changed the algorithms or any of the way the banks are looking at things?
It adds a little more risk to the process. I mean, if comps in your neighborhood jump up $200,000 and you go from a negative equity position to a significantly positive equity position, the net present value, the investor's looking at, if we sold the home in foreclosure, what are our net proceeds? Well, when you're underwater, they're clearly taking a loss on the loan. If you have enough equity, after costs and fees and delinquencies and auction costs and all that, they could potentially make more money on the loan foreclosing than modifying, although, in the last 2 years, we've had an 88.7% success ratio. So, there's always an element of risk. It's an uncertain outcome. It's a voluntary concession by the lender.
Right.
That's part of the risk you manage. We're very selective on who we take. And, if somebody's got a lot of equity and they're NPV negative, we just won't take the case or have the client spend money.
Got it. So, and this one either for Bart or for Corey, assuming somebody did go forward with either the loan mod or the foreclosure, obviously the credit does get affected one way or another there. What's the first step to rebuild that? Corey, I guess
that's probably more
for you.
Well, first is assuming that the modification's complete, in place, right? So the first step would be to run a credit report, run a full new tri-merge credit report. Don't go to Credit Karma. Don't go to free annual report. Get an actual credit report from a loan officer. Call in, get a copy, find out what's going on, and then come up with a game plan as to by when we can actually start working on the case, meaning removal of the lates, right? And so in the removal of the lates, you want to look at how payments were being paid previously. Was it an automatic? Was it an ACH account? Was it electronic funds transfer? Were there checks that were written? You want to be able to take a look, because oftentimes in the modification, you'll see a discrepancy between the actual amount of lates on the credit report and how many lates are the creditors being reported.
Got it.
And so that's the very first step. You can oftentimes remove a number of lates right off the bat.
Oh, excellent.
On a credit report, yeah.
And then how many points would you say a loan mod or foreclosure affect your credit score?
You're looking at 125 to 150 points.
Just right off the top.
Right off the bat.
And then if you were late several times, does that number increase or does it not matter as much?
It's less. if you were late on a mortgage versus a
Now, what
loan
if
modification.
what if you got the loan mod, but you were late for 7 months before the loan mod?
It's all kind of, FICO hasn't really distinguished a lot of the scoring.
Got it.
Right. So I can share more about that later.
Okay, great. Because I actually do want to come right back into a question right about that as soon as we come back from the break. You're listening to Money Matters with Dino on K-Talk AM 1150. If you have any questions for myself or the guests that you hear here today, these are the true experts. That's why I have them here on the show. Call us at 949-720-1616. That's 949-720-1616. Or you can check us out online at moneymatterswithdino.com. The segment was brought to you by Title 365. We'll see you in a second.
If you're a business owner or have a high net worth, it's important you have the proper insurance coverages. However, from a financial standpoint, it's even more important to have someone else pay the premiums for you. That's right, it's called insurance premium financing. In short, it means we use a combination of loans and secured assets to fund the payment of your premiums for your life insurance coverage. With this unique program, there's no need to pay expensive annual insurance premiums or estate taxes out of pocket or out of your company's cash flow. Your assets remain intact, protected from creditors, while your family and business receive the security they need. I'll bet you'd like more information. Simply call James Burns at 866-544-8825. That's 866-544-8825. Or go to whitediamondinsurance.com.
Finally, a reputable legal firm. CDA Law Center, a nationally recognized nonprofit homeowner advocate, one of the most trusted firms in the country for helping consumers with their loan modification process. CDA's attorneys have decades of combined experience guiding their clients through the very complex and choppy waters of loan modification. Call 877-499-4435, 877-499-4435. Finally, honest and ethical advice to gain real results. Call CDA Law Center at 877-499-4435. That's 877-499-4435. Or check them out online at cdalawcenter.com.
Mortgage professionals, are you looking for a company that values you as a loan officer? One that can provide you with the tools you need to grow your business at your pace? Then look no further than CHL Mortgage. CHL Mortgage provides you with a full range of residential loan products and services. You'll be backed by an exceptionally trained team of professionals that can take your clients as seriously as you do. Your clients will be treated with dedicated service, personal integrity, and exceptional professionalism. You'll be able to guide them in the right loan with competitive rates and keep them on the road to achieving life's goals. To get started on advancing your career, call Dino with CHL Mortgage at 949-720-1616. That's CHL Mortgage, 949-720-1616.
Welcome back to Money Matters with Dino. If you have any questions for myself or my guest, give me a call at 949-720-1616. That's 949-720-1616, or check us out online at moneymatterswithdino.com. This next segment is brought to you by Citywide Home Loans. And guys, Citywide Home Loans out here in California, also known as CHL Mortgage, we have a couple things that we do. On the purchases, we do 15-day closings. So if you're having your offer, if you're not having your offers accepted, try us out. We can get you approved a lot faster. And it's kind of like competing against cash buyers, because if you can close in 15 days with no loan contingencies and 10-day appraisal contingencies, you're going to be right up there at the top of the line. The other thing that we are just rolling out right now are stated income products. All you have to do is have a 680 credit score, and we can go up to $1.5 million on stated income. So give me a call if you're interested in that, 949-720-1616. All right, let's get right back into these questions. Corey, we were talking about credit. What does it take to improve your credit score? Let's just say like 50, 60 points or more even.
Yeah, well, there's a lot of different ways to do it. So one of the easiest ways would be to make a balance transfer. So if you have a credit card that's got a high limit, you have let's say you've got a Visa card that's got a $10,000 high credit limit and you're at $8,000. And then you have an American Express card or another card, for example, maybe a MasterCard that has no debt on it but has a $10,000 limit. One of the things that you can do is move a percentage of that $10,000 over to each of those cards.
Okay.
So if you move, $3,000 of that 10, so you move 6,000 to the Amex and 6,000 or 3,000 to the other card. Now your numbers are different. So your ratios shift. So you can get a credit score increase very, very quickly just based upon doing a balance transfer.
Okay.
So that's
Pretty
one
easy
way.
stuff.
Very easy stuff. Take you 15, 20 minutes with a creditor. And then, of course, you can ask for a line increase. If your credit is strong, you can ask for a line increase. So you can ask to take that 10 to a 20. So now instead of 30%, so if you had 3,000 against a 10, so instead of having a 30% debt to high credit limit, now you've got 15%.
Got it.
Right? So that can really make a difference.
Okay.
May not pull out 40 or 50 points.
Something I hear all the time with my clients is, I have a credit card, but I pay it off every week. And correct me if I'm wrong, what I always tell them to do is there's a statement cycle within, that credit card. Sometimes everybody thinks it always ends at the end of the month, but it could end at any given day of the month. Let's just say this one ends on the 15th. I always tell them, go online, pay the balance like on the 12th, before that statement cycle ends and produces the new statement. Because when you get your statement, it shows a $2,500 bill. Even though you pay it off for the next 30 days in the credit report, it'll show the $2,500.
Yeah,
is that correct?
Yeah, that's correct. Yeah.
Okay, so a real easy way for people is having a lower, from what you just said, having a lower balance helps increase your score. So even if you pay off your bill, go online and do it before the statement ends. So this way it'll show up a lot less for the following month.
And ultimately, the best way is to just set it up on automatic debit. So at least you have your monthly minimums covered, right? So you never have a late payment.
And always before.
Because what they'll do under the terms and conditions of the credit card, they have the right to take you from a 6.9% rate to 27.929.9 just by missing a 30-day late.
And now what was crazy was during the Great Recession when so many things were happening, people were skipping their payments so they could qualify for a loan mod, or they just couldn't make the payment anymore and they were going to go into foreclosure. And ultimately credit cards or all these other creditors that they had started either canceling them or raising their interest rates.
And lowering limits.
Their limits.
Yeah.
Just really put a strain on people.
Yeah, you have a $50,000 Citibank card. It happened in my situation when I went through my loan mod. $50,000 line of credit took me down to $2,000 overnight.
Wow.
Hello. It's a wake-up call.
The president of TransUnion came out and said that these strategic defaults by borrowers is not your traditional default based upon overextending credit, that it's much more for strategic reasons because of the unique circumstances we're in. It was kind of an interesting comment by the head of a credit bureau, because they're recognizing that people who are doing this for strategic reasons, they don't have the traditional, overburdened debt. They're not, their credit lines aren't maxed out. They have income, good credit history, low debt lines, but all of a sudden you have a mortgage late. The bureaus are starting to, I think, bake that into their algorithm here at some point. And, the president of TransUnion actually talked about that. It was, 6-8 months ago.
Wow. That is an interesting comment, though.
Yeah, I haven't seen it yet show up in the FICO scores as it relates to the difference between a short sale and a foreclosure.
Yeah, right. It's part of their algorithm, so who knows what they're doing. But we find that clients that are 60 days late to qualify for a mod tend to be, it's a 60-80 point hit. I mean, obviously the higher the credit, the greater the impact initially, but it's pretty recoverable.
Good. Hey, Bart, I got a question for you. I want to get you back in the game over here. In my opinion, we were talking about age groups earlier. I always feel kind of like that 40-year-old got hit the hardest because they were the ones. The 30-year-olds had just gotten started, maybe bought their first house. A lot of times, the 40-year-old had just bought that move-up house. Typically has the young family. Typically was a little further along in their career. It seems that at least out of my clients, they're the ones that got hit the hardest. So let's take a 40-year-old, for example, in your profession. If he came to you and basically got wiped out, what path do you put him on? How do you get a 40-year-old ready for retirement? I mean, he's starting a little late now.
Sure. Well, first I would tell him take a big deep breath. I would tell him to remember the things, to be thankful for. He may have lost everything, but, perhaps hopefully still has his job, his family, his health, and, focus on that for a minute.
Yep.
Then next step, and not sound.
What if his wife divorced him too?
And I would just say, pack it in.
Take a deeper breath.
Yeah.
It's called Jack Daniels.
Okay, so then what?
So, not to sound like a broken record, but I really think the financial plan is really the roadmap or the blueprint for anyone's future, and especially someone in that particular category that needs to start over. Start with a financial plan. Find a good advisor. Make sure he's maxing out his 401k is generally a general recommendation. Outside of that, you want to make sure that the foundation of the pyramid of a financial plan is to have 6 months worth of savings in a liquid account. So make sure that's funded. Make sure he's properly insured for his future, and so that any risks that might happen, he's got a means to take care of that. Once all those things are settled, then we start looking at the real true investing, and that's investing outside of the 401k, and that would be a brokerage account and with a properly allocation that's probably going to have to be a little bit more aggressive than maybe he was used to make up for lost time.
What if that person has debt? I mean, do you pay off the debt first, or do you just say, you know what, it's going to take a while, I have to put 10% aside or whatever it is to start investing?
Unfortunately, there's no blanket answer for that. Going through the planning process will help to determine. Generally, there's a balancing act. If there's debt, let's take a look at how much interest is being charged on the debt. If it's a relatively low interest, perhaps that's easy, free money and investing. If it's very high interest, well then a good portion is going to take care of that. So
a good friend of mine has the solution. I'm surprised you didn't mention it here, but he always says, he goes, "Bro, you can marry more money in 5 minutes than you can make in a lifetime." Gets you out of all your problems.
I'll have to remember to add that to my bag of tricks.
All right, let's talk about REITs, real estate investment trusts. Bart, do you deal with those at all?
We do, yeah, absolutely.
Tell us about what they are and how can a normal Joe use that. Okay.
So REITs come in a couple of different flavors. One is an open end, one's a closed end. An open end trades freely like any mutual fund. Step back. First of all, a REIT is a bundle of real estate or mortgages. It's bundled like a mutual fund. Hopefully, listeners know what a mutual fund is. So it's a series or a bundle of these items, and then with other people's money, it goes in, and now you have a part ownership in that bundle of real estate or mortgages. An open-ended one is one that can trade freely. You can buy today and sell tomorrow. The ones that I've had most success with in the last few years have been what are known as closed-end REITs, meaning once you get in, you can't get out for anywhere from perhaps 1 to 5 years. And there is triggering events, and that triggering event will be some sort of a liquidation event. So in the case of ones I've been using recently, some were commercial. We had some success with that. So commercial real estate was purchased. My investors were part owners of this real estate at the end of the term, and during this process, incidentally, we're making 6 to 7% per month every month. At the end of the process, 2 of them went public. They had an IPO, became a publicly traded stock, in which case we sold them for between 20 and 30% above offering price. So 6.5%, 7% dividend, another 20 to 30% capital gain. That was a pretty good investment for about 3 years.
Yeah.
And in the third case recently, it was purchased by a larger REIT. Same sort of performance numbers, but just a slightly different liquidation event.
Got it.
And at the end of the day, we really like those. We put those in the alternative investment category. Bonds, which is probably a whole other topic of discussion, but we're really looking for alternatives to bonds, and the fact that interest rates are going up, the value of bonds are going to be going down, and a REIT that pays that kind of dividend and then has that pop at the end, we find is a good alternative.
So what about trust deed investments on a solo basis, just a case-by-case basis? Do you manage anything like that, or do you believe in those, or would you rather see people put their money more into like the stock market or one of these other?
I'm not in that space in what I'm allowed to provide for clients, but I do have clients that are doing it independently, and I have reviewed some, and it appears the ones that I've seen have made a lot of sense. Okay. I would advise a person to make sure they do their due diligence and working with someone that can advise them properly on that.
In case you just jumped into your car, you're listening to Money Matters with Dino here on K-Talk AM 1150. Today we're talking about rebuild your fortune starting now, and we have the 3 professionals here. We have Bill Baskin, the loan mod guy, who helps you get through the process if you're underwater in your house. We have Bart Zandbergen, Gosh dang, did I say that right again?
Got it.
I keep thinking burger. I think I'm hungry. Anyways, the financial planner to help you be put on the right path to get back into the right retirement stage if you lost money or were in a situation like that. And of course, Corey Goldstein, fixing your credit and getting yourself back to a place where you can qualify for the better interest rates and just qualify for things again, and being a legitimate U.S. citizen again, right? Because without credit, you got nothing.
Yep.
All right, let's switch gears for a minute. Bill, if a loan modification isn't available for somebody, is bankruptcy a viable option?
It depends on the circumstances. I can't give bankruptcy advice, so this is not legal advice. This is opinion. But a bankruptcy. People don't realize that 81% of people fail Chapter 13 bankruptcies. Why is that? Well, the trustee eliminates some debts, but they put you on a basically a hand-to-mouth, month-to-month type trustee payment covering all the remaining debts that are there. But if your income is variable, if you're self-employed, if you're on commission, there's a very high probability at some point your income's going to fall short of being able to cover that trustee payment, and the bankruptcy will dissolve. When it comes to fixed assets like a real estate, if you're behind on your mortgage, they take your original mortgage payment, they break up the delinquency into a number of payments up to about 60, add it to the original mortgage payment. So if you couldn't afford your mortgage originally, it actually gets higher in a bankruptcy.
Oh, wow.
So, it's a good option for some, not for everybody. There's still a lot of stigma with bankruptcy as well.
Is it true, though? I've heard that judges on the spot have done a loan modification, and banks have no option if a judge wants to do that. Is that true?
No, as a matter of fact, they've tried to do that in Congress 3 times, but the banking lobby still writes the bills up there.
Interesting. What about like HELOCs or just seconds in general? Do bankruptcies dissolve those? Or
you can lien strip in bankruptcy a second. You make an offer. You have to have some cash to kind of offer the debt. There's so many of these second liens have been written off, charged off, sold to debt collectors at this point for pennies on the dollar. They're quite often willing to accept a cash settlement for the debt and erase the lien. I've had employees actually that have $160,000 seconds. Just they get a letter in the mail one day saying it's extinguished. I mean, there's a lot of crazy stuff. Yeah, just disappearing.
Wow. And what about in situations if you're going to make an offer? What kind of pennies on the dollar do they typically accept, or is it just different every case?
It's different. It depends on the investor. I mean, some banks are very proud of these things, and others are just looking to get off them. So, that's definitely a case-by-case basis.
Well, it's very interesting, and I've heard of a lot of great situations like that happening as well. Several of my clients, it's just gone. Same as what you said, letter in the mail, just no longer owe that kind of money.
It's a good day.
It is a good day for them. Well, you're listening to Money Matters with Dino on K-Talk AM 1150. We can be heard every Saturday afternoon from 12 to 1. If you miss any part of the show, you can go to moneymatterswithdino.com or contact me direct for any advice you need. As far as our guests here today, I can put you in direct contact with them if you call 949-720-1616. That's 949-720-1616. This segment was brought to you by Citywide Home Loans. Be back in just 1 minute.